Hi, it's Coach Joe Lucas, and welcome to the Magellan Network Show. My goal inside of this communication, this show, is to share with you my nearly 30 years of coaching some of the most successful financial advisors in North America. We're going to be talking about strategies, syntaxes. We're going to be bringing guests on from time to time, and I'm going to share with you what's working now. So think of this show as sort of like a little one-on-one kind of mini coaching cast, if you like, where we're going to be going in depth from time to time on strategies to help you grow your business, get more effective, become more efficient, find balance in your time management, grow your business, and quite frankly, whatever else is going on in the world today. So before we get to today's episode, I'd love for you to do a couple things for me. Number one, make sure that if you're watching this on YouTube, that you subscribe to our YouTube channel. If you're doing the audio, make sure that you give us a review on whether Spotify or Apple. We'd really appreciate that. And quite frankly, that does help. It does matter when you rate things and like things and subscribe to things. It helps us get the word out to more of the industry. And lastly, I have a very special gift for you. Go to MagellanNetwork.net, so one word, MagellanNetwork.net, and I have for you a complimentary membership, 100% gratis, where you can tap into about between 50 and 75 hours of masterclasses, forms, tools, templates, and strategies. So please go ahead and make sure you go get that claimed, smash the like button and subscribe. And please go ahead and leave us a review on whatever podcasting platform you're on. And now, let's get to this week's episode. Welcome to this episode of the Magellan Network Show. We're going to cover something today that I've never really covered before. We're going to call it P squared, so P with a little 2. Now, what does P squared stand for? It stands for pricing and profits. One of the things that I'm often asked by advisors is, hey, what should I charge, or what do you see other advisors charging? Now, I'm sure there are industry surveys that will justify pretty much any fee that you want to charge, but here is what I have found in my experience. Advisors will charge their marketplace what they perceive or their own self-perception of value and worth. And the reality is that it's woefully, in my mind, inadequate in most cases. And so let me give you some examples. And what I'm going to do for the sake of this conversation on the pricing side, is I'm going to break it up into what I call 3 channels. Okay. And now some of you may only use 1 channel, some of you may only use 2 channels, some of you may use all 3 channels, and hopefully that is the case here. So what are the 3 channels? Number 1, what do you charge for a financial plan? Number 2, what do you charge for asset management? And then number 3, what do you charge for, which is, I think, the future of our business, that retainer-based financial coaching, consulting, planning model, which we'll get into that a little bit in our conversation today. So let's talk about industry, right? What is the average, right? Which is a terrible question because here's what most advisors do. And in my space, now, granted, I coach advisors, but I've been guilty of it too, and I stopped this practice 10 years ago. We all worry about what everybody else is charging, right? I wonder what the person down the street is charging. I wonder what this firm is charging. I wonder what that firm is charging. And I'm going to give you a great example. So let's just talk about financial plans. Now, I don't care if you use Money Guide Pro, eMoney, one-page financial plan. I don't care if you use the back of a napkin, right? Here's reality, right? I have clients that will charge $500, and I've got clients that will charge $5,000 for basically the same process, right? And when I say basically the same process, let me explain that, okay? We're talking about a W-2 couple, right? So we're not talking about a business owner with 18 different LLCs or anything like that. We're talking about standard retirement planning. I've got clients that will charge $5,000 for that, and I got clients that will charge $500 for that. Or let me rephrase it. I've seen advisors charge $500. I've seen advisors give it away for free. That's a whole different conversation. So you can go from free, $500, $5,000 for basically the same thing. Okay. So what do we have there? we have a minimum 10x differential, right? And then if you're not charging at all, then it's almost to infinity, right? So how did you come up with the number? I'm going to tell you how. For most advisors, what I have found is they come up with their pricing basically what I call the mouth test. Now, what is the mouth test? The mouth test basically is whatever number you can get out of your mouth without vomiting or puking on somebody is the number, right? That's your number, right? And look, the best strategy that I've ever used to help clients raise fees, I'll always say, what number comes to mind? Let's just say we're going to do Money Guy Pro. Well, what can you charge for Money Guy Pro? What's the number that comes to your mind that you can get out of your mouth without, convulsing? $1,000. So great. Add 20% to that. Now we're at $1,200. That's your number, right? Because if you can get it out of your mouth easily, then it's not uncomfortable enough for you. So we got to go plus 20%. And what you'll find, and this has been my record throughout my entire experience, is that when you do a couple of those for $1,200, you go, oh my God, these are a lot of work. I need to get more. Then you go to $2,000. I've got clients today that are charging $10,000 for a plan, and they literally started at $500 or $1,000 3 to 5 years ago. Okay, so remember, if somebody says, "Well, Joe, what's the right price?" The reality is it's going to be evolutionary anyway, right? So it's not like, oh man, I got to get it right for all eternity. You've got to get it right for now, and then you go deploy it. So many advisors are so, especially if you've been in the business for a while, are so freaked out about charging for financial plans because in their brain, well, I got to charge $5,000 or $10,000. I'm like, you'll never get there. It's too big of a river to bridge in your mind. So pick a number, and look, let's be very clear also. Nobody in our space is going to get wealthy on doing financial planning, okay? Unless you and your company are pumping out thousands of plans a year, it's just, it's time for money basically, right? And that's, for every human being, there's a limit to that, okay? So how do you come up with your financial planning fee? Whatever number gets out of your mouth, plus 20%. Now, this is very critical. There are basically two types of scenarios that you're going to get involved in. The one I just mentioned, right? The nice and clean W-2, some 401k stuff, and away we go. You get involved in the business owner space. Business owners, especially successful business owners, what other business owner would you want to deal with? That's an entirely different game. And the way I explain it is it's the difference between doing individual wealth planning and doing 401ks. Two different disciplines, okay? So if you're going to get involved in doing business planning, coaching, and consulting, which is what I call it, I've got clients with initial plans, $15,000, $25,000, even $50,000 for initial plan. Because if you've got somebody that's got, a 7 or 8 figure business, multiple entities, right? Investment, real estate, all sort of jazz going on, do not underprice yourself. You'll get slaughtered with the time, okay? So, again, in that situation, I don't see how you do a financial plan for a business owner for anything less than $5,000. My mind is probably closer to 10. And like I said, I've got clients that are charging anywhere from $25,000 to $50,000 for the initial plan, okay? So again, come up with a number, get it out of your mouth, add 20% to that, be uncomfortable. And then always be raising your fees. Very important, okay? Next, let's talk asset management. Okay, here's another thing. I've got clients that charge 50 basis points, and I've got clients that charge 2 full points. So about a 400% differential. Who's right? Again, what do you think you're worth, right? And I know some of you sit there and say, Joe, I would never take 2 points. Well, then, okay, fine. Then what would you take? What's that number? Plus 20%. We want to stay uncomfortable. And by the way, all this boils down to how much revenue do you need from a particular client, a particular household. Because at the end of the day, like we're cobbling this together, right? We're gonna have a project plan, right? Which we just talked about. AUM fees, 50 basis points, 2 points. Who's right? Who's right? And this is why it's fascinating to me, almost after 30 years, that our industry still struggles with this. A lot of you do. What's the right number? The right number is the number you get out of your mouth. Okay? And if you get it out quickly, you're undervaluing yourself. You want to have a little angst, a little uncomfortableness when you're talking about pricing. And by the way, never use the word, so bonus here, Never use the word fee, right, or price. Hey, the investment for this project is. The investment to have me run your money is. The investment of. This is about investing in a relationship. This is about investing in outcomes. Nobody likes price or fees. Okay? Keep that in mind, right? How you frame it matters, right? So again, on the AUM side, pick a number, right? Now, let's talk about the third channel, right? Ongoing. So after you do the plan, after you get the money going, right? And I'm not really going to talk about it like, products. I know some of you do products. I'm totally, that's cool. You're going to get paid on, look, the creator of that project, most likely an insurance company, they're going to pay somebody a commission. So you might as well be you, right? And again, you'll always do it in the client's best interest. So we're not going to really talk about that. But now, as far as ongoing coaching and consulting. So again, we're going to have two different scenarios here. We're going to have Tom and Mary, W-2, right? Getting ready to retirement. Maybe they're 5 or 10 years out from retirement, right? You've got some of their money, right, that you're deploying. You've done a financial plan for them. But they want to stay connected. They want to talk to you once a quarter. They want to do an annual review. How are you going to price that? I've seen anywhere from $250 a month on a retainer up to $1,000 a month for a retainer. A good way of gauging that, by the way, is household income, 1% to 2%, is a kind of a good place to kind of look for that. And I know some of you are going to sit there and say, well, Joe, how about the asset management? What do we do there? I said, well, remember, these are different functions. So let me be very clear. This is where advisors they screw themselves. You have two different functions after the project. Okay, I'm clear on that. You have a function of deploying assets / capital, right? Whether you're running your own models, using third-party managers, whatever you're doing, right? You're responsible for that. You can be sued for that. There has to be a fee associated to that. Okay, number one. Now, if we're doing financial coaching and consulting, right? Checking in, accountability, doing reviews, well, that's a separate deliverable here, right? That channel. We need to get compensated for that. The model has always been, and I don't want to get too deep into this because we can spend a lot of time on this, but I do want to address this. If you look at our industry and the history of our industry, okay, and I'm going to talk for those of you sidebar. So I will be in Vegas next week at Jolt / the Snappy Kraken Conference. So if you're going to be there, come hang out. I'm going to be doing a talk just on this subject a little bit, and come introduce yourself. Love to meet you. So with that being said, let's have a little history lesson. So when our profession was established, let's call it 100 years ago, it was called brokerage, right? Which is the buying and selling of something, right? You have a buyer, you have a seller, the broker puts buyer and seller together, they receive a commission for that, everybody gets rid of something, somebody acquires something. And for decades upon decades upon decades, right, that's the way our industry ran. And then lo and behold came the 90s, and all of a sudden now fee-based showed up, right? In other words, so instead of paying for the transaction, let's just charge you one flat rate. It's like all you can eat. It's like a buffet, right? And so we went from the commission game to now the fee game, right? The AUM fee game, which I think will always be around in some way, shape, or form, okay? But now there's a new game. Now we're getting into, we got into the consulting game, right? The planning game, the advice game. Well, now we're going to get into the coaching game. We're going to get into the accountability game. That's the next evolution of our industry. And inside of that evolution, this is not hypothetical, but clients that run these models. They run them very successfully. So it's not like I'm, spitballing this here. And I'll tell you that when you run we'll call it a retainer model, right? So I got retainer, I do a plan for a fee, I run the money, and I do an ongoing retainer. Man, that's a home run for a client relationship, right? Because they value all three things. So on the retainer side, W-2 again, I said anywhere from $250 a month to $1,000 a month, right? From that perspective. Now, on the business owner side, it's a totally different animal. I just had a client, he had to amend his ADV for planning. He's doing a $25,000 initial plan. We're going to take over all the assets, and we're going to be pretty aggressive with the fee structure there because there's a lot of money there plus the K plan. And then ongoing, we're charging $5,000 a month as a fee to work with the entity and the owner's family, right? as their financial coach, consultant / personal CFO. Okay? That is the future if you want to play in the business space. So you get, and then whatever's going to come out of that, right? So again, what do we notice? Now, does it have to be 5,000? I'm going to give you an example. 1,500, 1,000, 2,000, $2,500. You have to determine what you think it's going to be worth. Now, when we say what it's going to be worth, I am not a fan of saying, well, I'm going to charge $150 an hour, which by the way is way too low, and I'm going to spend so many hours, because then we get into that game. That's not a game we really want to get into. It's really about what the impact is you're going to have with that entity, right? So we've got, again, we've got our project, our AUM sleeve. And look, and I've got clients that will charge, if we're charging, let's just say $5,000 a month on a retainer, hey, we could run all that money at 50 bips. And by the way, I'm not an accountant, I'm not a CPA, but I've been told, because of the way you'll be treated as an outside consultant, that you will get a 1099 from the entity, because the entity to be the one to retain you, and therefore the business owner gets to deduct you, where the AUM fees are no longer deductible. I'm not a tax expert, but that's what I've been told. So if you take that in consideration and you want to work with a business owner, you have a real competitive advantage here, because let's just say you're at one of these legacy firms, one of the legacy wirehouses, right? They can't run this model. They can't charge $2,000, $3,000 a month retainer. There's no mechanism for that. So it really puts you at a real competitive advantage, right? So you can go down that road. So point being is this. Whatever you're going to charge, put 20% on top, right? Get uncomfortable and don't be afraid to raise your fees. I have got clients, even in this environment today, raising fees, raising AUM fees on existing clients, right? Raising retainers on existing clients. And you know what you find? In 98% of situations, all the fear was in the advisor's mind. If somebody's going to really push back at you, they are looking for an excuse to get rid of you anyway and a justification. Guess what? Give them that justification, open up a slot, you deserve better, right? It's time to stop living in fear and scarcity and uncertainty, and we as an industry need to be compensated for the value, the massive value we bring to the table, okay? So that's segment number one. I'll just do this in one segment today. So that's the first P of P squared. Let's talk about the second P, a word called profits. I just had a conversation with my Magellan Network Pro group in the morning. Every day we release a little video like this, a little shorter, of course. And we were talking. I go, hey, what kind of profit margin do you want? And nobody knows the answer to that. So let me give you a couple scenarios. And I'm going to kind of go off of maybe two different scenarios. One that you're kind of running your own shop. The other scenario is that maybe you're involved in somebody else's shop, right? In essence. So let's take a simple client, and I'm going to keep this simple for just the conversation. So we're going to have $1 million household, and we're going to run a legacy model. We're charging 1%. We have $10,000 coming in top line every year. Okay, simple, right? So I am at a major firm. Okay, I'm at a major firm. So right away, I'm going to take a 50 to 60% haircut on that. In essence, I ain't paying the firm. I know the firm likes to think they pay us. My psychology is we're paying them. They're our business partner for good or for better, for worse, in sickness and in health, right? So out of $10,000 top line. Now let's keep it simple. Let's call it 40%. Let's say you're at a 40% payout. So now I've got $4,000 net. Okay. Now watch this. Now I'm going to work on the premise that you're going to meet with this person twice a year for a couple hours, a meeting, do a semi-annual review. Every month you're going to reach out to them, or a member of your team's going to reach out to them, right? You're going to make sure their estate plan's done. You're going to rock star everything you do, and so there'll be some phone calls in between, some check-ins, stuff like that. So just keep that in mind, okay? So now I'm at $4,000. Does your firm, in this scenario, cover all of your expenses? So your marketing expenses. Maybe you have a part-time assistant that you got to put some capital into, right? How about your coaching, training, personal development? Yeah, I know they do it pre-tax, but it's still your money. Don't forget that, okay? So let's just say out of $4,000, let's say there's another $1,000 in unreimbursed business expenses for this house, allocated, right? And the way you allocate it very quickly, there's a lot more precise ways to do this, but here's a simple swag. Take all your business expenses, divide it by number of households. That kind of gives you a little sense of what's going on in your business, okay? Very simple. So let's say I've got another $1,000 for unreimbursed. So now I went from 10,000 to 4,000 to now 3,000. What am I missing? What am I missing? Oh, taxes. And if you're one of those lucky people live in a state that has taxes, in Florida we don't, you're probably paying, and if you're any kind of level rock star, you're probably around 50% tax bracket, okay? So I go from 10,000 to 4,000 to 3,000 to $1,500. $1,500 on a $10,000 top line, okay? Now, what happens if we take it down by 50%? Now I've got $500,000. Let's say I keep the same ratio, $5,000 top line, right? Well, we know that I'm gonna be down almost 2,000, right? But I'm down to on 40%, 2,000. I still have that $1,000 unreimbursed. I'm down to 1,000, and now I got to pay tax. Get skinny real quick. All right, and I'll quickly do the RA side or the independent side. So let's say I'm gonna keep it simple. I know some of you have grids and like 90% payout, but I want to keep the math simple here. So I'll take that same scenario. You have a $10,000 top line. You have to pay your own expenses now. So it depends again how you run your business. But I mean, typically, if you've got any kind of scale scope and you're doing a really good job, you're probably going to be somewhere around the 60% margin rate. So out of 10,000, I get 6,000, right? And 6,000, I've got to pay tax on that. And so that's going to leave me, let's keep it simple, it's going to give me 3,000, right, on that. So 30% gross margin. So you have to understand margin. So here's really the conversation. You have to make sure you make a profit. Trading time for money is not profit. It's just trading time for money. Remember, there's your salary and then what your business is allowed to make in terms of profit. Most people don't think that way. Most advisors don't, okay? You, in essence, I want you to treat yourself as an employee of your business. So if you were going to sell your time to your company, what is your time worth? And there's a very simple way to kind of swag it if you like, because again, there's so many different scenarios. We can't go into them here, but I want to give you a sense of it. Again, this goes back to the man or woman in the mirror. So if I said to you, look at the other professionals, the CPAs, the attorneys, what do they charge per hour, right? The good ones. I'm not talking about somebody starting out, somebody that would be your contemporary, your a comparable, right, in essence. And let's just say it's $250 an hour. Okay, well then that's your number, right? So you're charging your business $250 an hour every day, right? There's your number. And figure that out and understand your levels of profitability. Most advisors, and what I found is they woefully undercharge small relationships. You will lose money that way. Because, and here's where it matters, and I don't get into the different business models because we can be here for hours and we're not going to do that today. But let's just say, let's just we'll talk about the solopreneur, ensemble, enterprise, right? Keep it simple. If you're a solopreneur, that's pretty self-explanatory, right? And again, solopreneur, wirehouse, independent, doesn't matter. It's you. Maybe you have a part-time assistant or full-time, that's fine. But there's only one of you doing reviews. There's only one professional. You have to guard your client slots incredibly because you got to make sure every client, you can't have loss leaders. Every client has got to be a minimum. You have to establish a minimum base of profitability and then go minimum, not maximum, minimum. Because you're only going to have 100 to 200 client slots. That's it. And if you jam them all up with a bunch of $2,000 households, guess what? You're a nonprofit. You're not making money. Okay? So if you get into an ensemble where you can have a junior advisor, second chair, right? Well, then all of a sudden now they can, again, if they're salaried, right? You could probably get enough top line revenue into that seat where that becomes profitable. And I've got clients that will pay a junior $125,000 to $150,000, and they'll run a $300,000 to $500,000 sleeve of business for us. Hey, that's profitable for us. You know why? We're not doing it. So if you're going to go ensemble enterprise, there are different economic models, and we're not going to discuss them here. But I've got clients that are highly successful solopreneurs, and then I've got clients that run $4 or $5 billion empires. Okay. There are different economic models, but the rules are the rules. So here's how I want you to leave this conversation today. Number one, how did you come up with your pricing? Number two, raise your pricing. Next, Start looking at client household profitability. And I'll give you a great example. I was talking to one of my clients. They're at a firm. It's a team, as a matter of fact. They have a client, and this client is old school. I think it's like $14 or $15 million. That's not really relevant. They generate $60,000 a year of top-line revenue. Now that's relevant. They're a trader. 2 to 3, 4 conversations a day, every day. Sometimes not happy about things, right? Doesn't like to accept responsibilities when things don't go the way they want. And sort of abusive to the team a little bit, right? So very needy, high maintenance. Let me ask the question. 60,000 down to 30, right? I'm going to keep the math. I know the firm's grid. So let's 60 down to 30, 30,000 net. Now I know they pay out of their pocket for some of their team. So I bet you that 30 is probably down to 20 to 15 real quick. 3 partners, high tax bracket. Is that juice worth the squeeze? Interesting. That's why we all need to think like business owners and understand pricing and profitability. So hopefully I enlightened you, open your eyes a little bit, take some action on this. And once again, make sure you're subscribed to our YouTube channel, our podcast. Like the podcast, write a little review. That does matter. Forward this episode to 3 or 5 of your colleagues. Let's help get the word out here. And make sure you check out the MagellanNetwork.net. And I will see you next week, probably from Nevada, when I'm on site doing leadership and doing the Jolt Conference. Have a great week. See ya on our next episode. Thank you for watching or listening to this episode of the Magellan Network Show. Hey, if any of this resonated with you, I invite you to come to MagellanNetwork.net, and we have a powerful group coaching community of like-minded advisors. Come in for a trial. You and I will have a one-on-one conversation. Let's see if I can help elevate your game, both personally and professionally.